This is Nightly Business Report with Sue Herrera and Bill Griffin.
Bounce back. Wall Street rebounds from yesterday's steep decline, but can this rally hold? Attention turns to tech. Alphabet, Amazon, and Intel, key drivers of this market rally this year, are out with their earnings, and their results could set the tone for tomorrow. The hunt for yield, why you may be able to find it in some rather surprising places. Those stories and much more tonight on Nightly Business Report for Thursday, October 25th. Good evening, everyone, and welcome. Bill Griffith is off tonight. What a difference a day makes. Stocks surged after yesterday's steep slide, pushing the Dow and the S&P 500 back into positive territory for the year. Upbeat earnings reports helped calm investors' nerves, at least for today, and the focus on quarterly reports put issues like rising interest rates and global growth back on the back burner. Here are some of the closing numbers for you from Wall Street. The Dow Jones Industrial Average rallied 401 points to 24,984. The Nasdaq advanced by 209, and the S&P 500 added 49. So is today's move to be believed, or is it just a short-term bounce? We're joined now by Neela Richardson, investment strategist at Edward Jones. Good to see you as always, Neela. Welcome.
Great to be here. Thank you.
Let's start, first of all, with what you make of the bounce back that we saw today.
Well, I think that bounce back, as you call it, is more than a bounce back. I think it really is to be believed. What we're seeing across the corporate sector is really strong earnings. Earlier in this week, the market really got caught up in the trees for the forest. They looked at trees instead of the forest. And what the market is concerned about is three issues: tariffs, higher interest rates, and slower global growth. And so they focused on a few high-profile names that indicated higher costs going forward. But this is in context of really strong earnings and really strong growth. And so we believe that a combination of solid growth and solid economic fundamentals means that the overall outlook for investments is very strong.
Do you think, though, that volatility that we've seen this past couple of weeks now, and especially in yesterday's trading session, do you think that's here to stay?
It's here to stay. And you know what? It's normal. And it's hard. I know it feels uncomfortable. We're not used to it. Last year, the market went through the entire year with never seeing a decline or a sell-off more than 3%. But the truth of the matter is this type of volatility is part of normal investment cycles. And especially as we get to the later stage of this bull markets, we can expect to see more ebbs and flows. Prices go up as well as down, but the overall trend is still positive.
So you believe we're still in a bull market trend, but where would we fall within that cycle?
We're late. We're late in the late stages. We're in a position where this bull market has been running, this increase in share price year after year has been running for 10 years. And so we are starting to see the signs of aging, but that aging does not mean decline. What it means is volatility, a return to normal volatility as the Fed returns to normal interest rate policy. Okay. And as we get to more normal financial conditions, that means that we are expecting 20% earnings growth this year, more than 20%, and double digits next year. That means that we're still seeing returns even as we enter this late cycle.
We have to leave it there, Neela. Thank you very much. Neela Richardson with Edward Jones. Well, investors hope that Intel keeps the rally going tomorrow because late today, the Dow component topped Wall Street's earnings and revenue estimates on strong demand for chips used in data centers. Intel earned $1.40 a share, easily beating expectations of $1.15. Revenue rose 19% to $19 billion. And investors also cheered the upbeat guidance, and that sent the stock higher in initial after-hours trading. John Fort has the details.
A solid beat and a raise from Intel. Revenue came in $1 billion above expectations, and the reason why, the PC, the good old PC, it just keeps on going. PCs and the data center business really drove this business forward, where a lot of people in the industry, and some could argue Intel itself, had left that business for dead. We'll have to see just how far they can ride that. Apparently, they'll be riding it into next year. For Nightly Business Report, I'm John Fort.
And now to Amazon, which turned in a record profit and blew past earnings estimates. But sales were not as strong as hoped, and neither was Amazon's outlook for the holiday quarter. The company earned $5.75 a share. Estimates were for $3.14. Revenue of $56 billion was up from last year, but less than expected. And that sent the stock sharply lower in initial after-hours trading. Deirdre Bosa has more.
The main thing investors are focusing on is Amazon's outlook for the all-important holiday quarter. Usually a blockbuster one for the e-commerce giant, Amazon's guidance failed to impress the street. Amazon CFO Brian Olsavsky said they're still anticipating a strong holiday season and everything is ready to roll. Analysts, though, are getting a little nervous about rising costs, particularly wage inflation, as Amazon raises the minimum wage for all of its workers in North America and as it faces potentially higher shipping costs from U.S. Postal Services. Amazon's other high-growth, high-margin businesses, cloud computing, advertising, and subscription services, they performed as analysts expected, and the company notched another quarter of record profit. The focus, though, is squarely on those holiday sales. For Nightly Business Report, I'm Deirdre Bosa, Vancouver, Canada.
Google's parent, Alphabet, reported a rise in profit but slightly slower growth in revenue. The company saw sales from its advertising business rise. Revenue from its cloud unit also grew, but not as fast as in previous quarters. The report comes at a time when Google is dealing with a growing backlash from regulators over privacy. The results caused the stock to dip in initial after-hours trading. And as all these earnings roll in, some market watchers are trying to figure out what might be in store for next year. Bob Pisani takes a look.
The stock market is a voting machine on next year's earnings, and for the moment, it's signaling that it's doubtful the companies can deliver on the expected earnings growth of about 10% and revenue growth of about 6%. Now, why is that? Because the macro picture has gotten considerably more complicated and, frankly, a lot more confusing. 6 months ago, we were dealing with a strong U.S. economy, tax cuts, and less regulation, and, frankly, not much else. Now the picture is much more complicated, with China slowing, tariffs, the Fed hiking too aggressively, but also a host of smaller issues like a strong dollar, higher labor costs, higher raw material costs, a populist government in Italy, and the possible isolation of Saudi Arabia. However, the main macro concerns are very obvious. China slowing and the Fed hiking too aggressively are the two main issues, and everyone believes the glass is half empty suddenly. How much less? The bulls think earnings growth will be 7 to 10% in 2019. The market seems to be telegraphing that that's unlikely to happen. The S&P 500 is trading at a multiple of 15 times 2019 earnings. It was 16.5 a month ago. Since the multiple is a reflection of the price investors are willing to pay for a future stream of earnings, this multiple is telegraphing that the market believes earnings might be lower than anticipated next year. So instead of maybe 10% earnings growth, the market seems to be anticipating earnings growth of roughly half that. That's a big haircut. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
It is time to take a look at some of today's upgrades and downgrades. Tesla was upgraded to outperform from peer perform at Wolfe Research. The analyst cites Tesla's free cash flow and the company's focus on cost and capital efficiency. As we reported yesterday, Tesla reported a profit for the most recent quarter. The price target is $410. The stock rose 9% to $314.86. Hilton was upgraded to buy from neutral at B. Riley FBR. The analyst cites the pullback in the stock and calls the current value an attractive entry point. The price target is $85. The stock was up more than 5.5% to $67.55. UPS was downgraded to neutral from buy at Bank of America Merrill Lynch. The analyst there cites the deterioration of margins in the third quarter. The price target is $116. The stock fell a fraction to $107.82. And still ahead, talk of tariffs is springing up in new surveys from the Federal Reserve. President Trump proposes sweeping changes to Medicare drug pricing. He wants to make some prescription drug prices more comparable to what they cost in other countries.
We're taking aim at the global freeloading that forces American consumers to subsidize lower prices in foreign countries through higher prices in our country. The world reaps the benefits of American genius and innovation, while American citizens, and especially our great seniors, who are hit the hardest, pick up the tab, but no longer.
The regulation would set up an international pricing index that would be used as a reference point to set prices for drugs paid for through Medicare Part D. And the president, as you know, has been very critical of the Federal Reserve's interest rate policy. Well, today, the central bank's vice chair said more rate hikes are warranted. In his first major policy speech since being seated at the Fed, Richard Clarida said that the strength of the economy broadly and the job market in particular has surprised him.
Based on my reading of the accumulating evidence, I believe that trend growth in the economy may well be faster and the structural rate of unemployment lower than I would have thought several years ago.
Clarida's view of monetary policy could change if the data shifts and inflation turns lower. Tariff concerns are showing up in the Fed surveys. Just yesterday, the Beige Book described the impact of the trade war on America's farmers, something that we've been reporting on from different parts of the country. Aditi Roy has the details.
Farmers across the country are feeling the pain of tariffs, according to the Fed's latest Beige Book. Soybeans appear to be especially hard hit. The Chicago Fed reporting farmers are seeing a notable drop in Chinese purchases of U.S. soybeans following an increase in Chinese tariffs. The Minneapolis Fed also reporting that worldwide demand for soybeans has fallen dramatically. And as demand falls, so does the price. Soybean futures on pace for their worst year since 2015. Analysts don't expect relief in the near future.
Their supplies are huge, and there's nowhere else to go with these futures prices but to go down.
The Beige Book remarks also align with the latest USDA data on soybeans. Just last week, the agency reported that since September 1st, U.S. shipments are down 97% from 1 year ago. The hardest hit areas are along the Mississippi River, Columbia River, and Puget Sound. This after China canceled 180,000 metric tons of soybean exports for the marketing year.
I think the announcement of the cancellation of exports to China is kind of like the last nail in the coffin, that we are going to be sitting here and maybe a little bit lower till the end of the year.
Dairy farmers are also struggling. President Trump in Wisconsin Wednesday telling the crowd the new NAFTA agreement helps U.S. dairy farmers by removing barriers to the Canadian market.
Now, as you know, the Canadian market, which was not open, is now open. Go do well.
His comments come one day after the National Milk Producers Federation sent this letter to Agriculture Secretary Sonny Perdue, asking for more trade aid and citing multiple studies which say dairy farmers will lose more than $1 billion this year because of the tariffs, dramatically higher than the more than $200 million of federal aid to dairy farmers from the administration as a result of the tariff impact. But earlier this month, Agriculture Secretary Sonny Perdue told Reuters the $12 billion trade aid package to U.S. farmers could end up shrinking after the new NAFTA agreement was negotiated. Other crops also seem to be affected by trade tariffs. The San Francisco Fed says wheat and fruit growers in Washington state are also seeing a slight decrease in demand because of tariff troubles. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Cancer drug sales help power quarterly results for both Merck and Bristol-Myers Squibb, and that's where we begin tonight's market focus. The drug makers reported better than expected third quarter profit and raised their 2018 earnings forecasts thanks to revenue from their immuno-oncology drugs. Merck also raised its dividend, but the stock moves were mixed. Merck's shares fell a fraction, while Bristol-Myers Squibb gained nearly 1%. Investors remain skeptical about Biogen's experimental Alzheimer's drug. One analyst said the latest data release was, quote, thin, and suggested that the treatment may only work in patients with a specific genetic variation. Others called the latest data confusing. Biogen shares were down 1% to $298.47. American Airlines gave an upbeat outlook for profit margins and is forecasting an additional $1 billion in revenue next year. But in the current quarter, the carrier said high fuel costs cut into its profit.
This run up in the last 10, 11 months of nearly doubling. That's volatility, and then falling off as it has just in the last week. So it's definitely volatile. But again, it's not for us to try and predict where it's going to go. We need to make sure that it's one of our large cost components, and when the cost of production goes up, we need to make sure that we're being able to pass that along.
Shares of American Airlines popped more than 6% to $32.37. Hershey plans to raise prices. The company will start charging more for chocolate as higher costs eat into profit margins. Food makers more generally have faced record shipping costs this year, as well as rising ingredient costs. Hershey shares were off nearly 5% to $102.84. Comcast reported a rise in profit. That company's broadband business more than offset a decline in cable TV subscribers. And the CEO said Comcast's Sky deal makes a lot of strategic sense.
Sky does look a lot like Comcast, NBC Universal. That subscription model, that market leadership, their brand is better than any media brand in the U.S. or communications brand. They really are a products company, and they have great leadership. We're going to drive a company that's so unique and now global.
Comcast, the parent company of CNBC, which produces this program, saw its shares finish up 5% to $35.84. And Twitter's earnings were better than expected thanks to an increase in ad revenue. The social media company reported a decline in monthly active users, but had previously warned that its efforts to remove fake accounts would likely have this effect. But the company says it is having success attracting new users.
We still see lots of opportunity to grow DAU. That's the best way to measure whether we're driving usage of Twitter as a daily utility. It grew 9% this past quarter. That's 8 quarters in a row where it's grown between 9 and 14%. And between the product improvements that we've made over the last couple of years and all the opportunity that we see to continue to improve the service, we see lots of ways that we can drive DAU growth.
And Twitter shares jumped 15% to $31.80. Well, investors on the hunt for yield may be basking in the recent stock market sell-off. Until recently, dividend-paying stocks had been underperforming the high-flying tech names. But things have reversed a bit, and now investors are looking for some safety. We're joined by John Petrides, portfolio manager at Point View Wealth Management, to discuss where you may be able to find some of that. Good to see you, John.
Good to see you as well.
Welcome back. It's hard to say that people are basking in the sell-off, but this is the first time in a long time that we've seen interest rates move decidedly higher and stay higher.
Right. I mean, in this environment where we had quantitative easing or money printing, where the Federal Reserve have kept interest rates low for so long, how many times have we discussed investors looking for yield, grappling anywhere for income? Well, now with the sell-off and interest rates rising, yield is abundant. So it's easier to find today than at any point in probably the past 10 years.
And you worked up some names for us. And you say some of these all have a little bit of hair on them, meaning that there may be issues within the company that they're working to resolve. One of the companies is Ford. And the big question that analysts have been asking is whether or not the dividend yield on Ford is safe. Why would you put money in Ford right now?
Well, Ford is really a good total return play. So you get a 7% plus dividend yield. The company reported earnings yesterday, much better than expectations. But it really is, the valuation is so low, the bar is so low for a company like Ford that they just really have to step over it. They don't have to jump over it to beat expectations, and that's why the stock looks attractive.
Some of the other names on that list include AT&T,
right.
GM, Invesco, and Southern Company. GM, I'm interested in that because GM has been performing better than Ford, certainly. Why do you like that auto space so much?
Well, again, they're cyclical companies. The U.S. economy is doing generally pretty well. Again, over a 5% dividend yield on a very high-quality company like General Motors. GM does have a stake in Lyft. The competitor to Uber.
That's the tech side of it,
That's the tech
right?
side of it, right? So I do think that is an option that's not being fully priced in for the stock. And I think, with the yield and at the current valuation, I think GM's a good stock here.
What about investors who may be already retired or they're not comfortable putting money in stocks right now in a big way? What part of the yield curve would you like, the bond market?
Oh, sure. So if you're going into fixed income, I don't think you have to stretch too far to pick up yield. You don't have to go out 10, 15, 20 years to pick income. You can go out 3 to 5 years. Okay. Buy bonds A-rated or better, and you're going to get a 3 to 4% type of return without taking on much risk.
All right. On that note, John, thank you so much John Petridis.
Thanks for having me on.
Appreciate it. And coming up, if you are looking for a reliable car, she tried to say, you may want to avoid buying American. Altria is pulling some of its vaping products off the store shelves. The tobacco giant said it plans to stop selling its pod-based devices until the FDA approves them or the issue of teens becoming addicted to e-cigarettes is addressed. Altria also said it would refrain from selling products with any flavor other than tobacco, mint, or menthol. The FDA recently targeted e-cigarette makers, urging them to put new measures in place to prevent teen vaping. Ford is recalling nearly 1.5 million Focus vehicles on concerns that a flaw in the fuel system could cause the engine to stall. That recall applies to the Focus models that were built between 2012 and 2018 with 2-liter 4-cylinder engines. Ford is also instructing owners to keep their gas tanks at least half full until the issue is repaired. And if you're in the market for a new car, you'll want to see this. Consumer Reports' latest survey is calling into question the reliability of many new models, particularly those made by U.S. automakers. So, which companies came out on top and which lagged behind? Phil LeBeau breaks it down.
The showrooms may look the same, but the cars and trucks we're buying are quickly changing, and that's creating new problems for their owners. Consumer Reports, which has ranked the most and least reliable auto brands for years, says the latest study finds domestic vehicles are average at best. Ford leads the list, but overall, U.S. automakers are struggling, especially when it comes to advanced transmissions and turbocharged engines.
The domestics fared worse than they have in years because of many new introductions and in the addition of new technologies.
Of the 29 auto brands evaluated by their owners, Tesla comes in third to last, in part because new software and hardware additions to the Model S are not working as owners expected. Meanwhile, Tesla's newest vehicle, the Model 3, has a higher reliability rating because it's not as complex. Overall, Toyota and its luxury line Lexus are once again ranked as having the most reliable models. Why? Consumer Reports says their conservative approach to making big changes under the hood means fewer things go wrong.
The Tesla Model 3 up until this point has actually been a pretty simple car. Now they're just starting to deliver cars with all-wheel drive. They are talking about adding an air suspension to it. There's a performance model. So hopefully they're able to maintain the reliability of the vehicle as the complexities increase.
Consumer Reports says most new cars and trucks have pretty strong reliability. The issue is when automakers push to make those models more advanced with new technologies, features car buyers love, when they work as promised. Phil LeBeau, Nightly Business Report, Chicago.
Finally tonight, not only are cars going high-tech, but so are banks. And it may mean robots will one day be a mainstay at your local branch. Leslie Picker recently attended the Money 2020 conference in Las Vegas.
Hey there, come talk to me.
Meet Pepper. She's a robot created by SoftBank, a concierge of sorts for the banking industry to help customers figure out tasks like depositing checks or opening accounts. The London-based bank, HSBC, thinks Pepper is a key to better customer service and next-generation technology for their branches.
It's been incredible, the feedback, and we're continuing to learn. Like, this is history. No one's done this before in a U.S. bank branch. We're learning.
HSBC brought Pepper to the Money 2020 event in Las Vegas that gathers together hundreds in the financial technology industry to discuss the future of money. I decided to take Pepper for a test ride to see what she could do.
Pepper, tell me about credit cards.
Whether you're looking for cash back promotions, low introductory APRs, or travel benefits, HSBC offers a variety of credit cards to meet your needs. Say or tap one of the options on the screen to learn more.
Cash rewards.
Would you like to learn more about applying for the Cash Rewards MasterCard?
Text link. Oh, I just got it.
When you hear the word robot, you may think job replacement, but HSBC insists that Pepper isn't replacing any jobs. She's augmenting those that already exist by handling the more mundane tasks. HSBC says Pepper ensures customer privacy.
There is zero customer data, zero personal identifiable information. Pepper's not asking for it, she's not storing it, she's not recording it.
Each Pepper costs about $25,000, an investment that HSBC says they recouped just 3 hours after installing her at their flagship location in New York this summer. The firm says she's brought in more foot traffic, and those customers have signed up for credit cards, checking accounts, and other revenue-generating products for the company. But Pepper's not all business. She loves to show off her moves. Tell jokes.
What do you call an alligator detective?
I don't know, Pepper. What do you?
Investigator.
An investigator.
And even take a selfie. Regardless of her gimmicky side, HSBC is banking on Pepper, even if she just helps someone crack a smile. For Nightly Business Report, I'm Leslie Picker.
Here's a look at the final numbers from Wall Street. The Dow rallied 401 points. The Nasdaq advanced by 209, and the S&P 500 added 49. That does it for us tonight. Thanks for joining us. I'm Sue Herrera. We'll see you tomorrow.